Bitcoin is not stuck because nothing is happening. Bitcoin is stuck because two completely different markets are fighting each other at the same time. Retail is buying almost every dip. The biggest wallets are using every bounce to unload into that demand. That is the real story right now. Not the green candles, not the red candles, not the influencers screaming bull run or crash. The real story is that small buyers are trying to lift the market, while large holders are leaning on it from above. And until that pressure changes, every rally will keep feeling fake. In the next few minutes, I'm going to show you why Bitcoin around these levels is not a clean breakout and not a full collapse either. It is a transfer. A slow, frustrating, highly deceptive transfer from impatient money to patient money, and from retail optimism into whale liquidity. And if you miss what is really happening here, you are going to read the next big move completely wrong. Right now, most people are watching the price. That is the trap. Price is the last thing to understand the market. By the time price tells you the truth, the opportunity is already gone. The real story is in the wallets. It is in who is absorbing supply, who is releasing supply, and who still has the power to decide whether Bitcoin grinds higher or gets rejected again. There are two groups that matter right now. The first group is small holders, the tiny wallets, the everyday buyers, the people buying fractions of a coin, adding on dips, averaging in, convincing themselves that this chop is accumulation before a breakout. And to be fair, they are accumulating. Quietly. Consistently. More than most people realize. The second group is the one that matters more. The heavy wallets, the whales, the sharks, the large entities that do not need headlines to move markets because their size is the headline. And those wallets, across the broader trend, have not been supporting the move. They have been trimming into strength, distributing into recoveries, feeding supply into every burst of optimism. That is why Bitcoin feels so unnatural here. Every pump looks promising for a few hours, and then it dies. Every dip gets bought, and then it stalls. Every breakout attempt attracts excitement, and then gets slapped back into range. That is not random volatility. That is not bad luck. That is not retail being emotional. That is a market absorbing supply from stronger hands, while weaker hands keep calling it the start of the next leg. Think about it like this. Retail is opening the door and bringing in more demand every day. But the whales are standing at the back of the room quietly pushing inventory out the side exit. So the room never really fills. The energy is there, the buying is there, the belief is there, but the net effect is disappointment. Because the supply that matters most is still coming loose from above. And that is the part almost nobody explains properly. People love to talk about sentiment. They love to talk about narratives, ETF hype, macro headlines, central bank policy, elections, tech stocks, risk appetite. All of that matters on the surface. But sustained trends in Bitcoin are not built by excitement alone. They are built by size, by capital allocation, by whether the biggest holders are pressing the gas or tapping the brakes. When they press the gas, Bitcoin does not ask for permission. It moves. When they tap the brakes, Bitcoin can look strong on the chart and still go nowhere for weeks. That is what you are looking at now. Small wallets have been increasing their share. That sounds bullish, and in one sense it is. It tells you retail has not given up. It tells you there is still appetite. It tells you this market has believers who are willing to keep buying weakness instead of running from it. That matters. It matters more than people think, because it tells you the floor is being built. But a floor is not the same thing as a launch pad. A floor can stop a collapse. A floor can slow a breakdown. A floor can absorb fear. What a floor cannot do by itself is create a violent, sustained, structurally healthy bull move. For that, you need the big money to stop selling. Not maybe, not sometimes, consistently. And right now, that consistency is missing. Now here is where things get more interesting, because there was a moment when it looked like the script might be changing. After that hard flush toward the low 60s, some on-chain signals improved fast. Accumulation behavior picked up. Mid-sized wallets looked more aggressive. Panic selling met actual buying. For a moment, it looked like the correction had done its job, like the weak hands had been cleared out, like the stronger players were beginning to step back in. That is why so many people got excited. They saw the bounce. They saw the buying response. They saw the data improve in a narrow window. And they assumed the next leg had already started. But that was only part of the story, because when you zoom out, the broader whale behavior still does not fully support that conclusion. Some mid-tier wallets may have bought the panic. Some players clearly stepped in when fear spiked. But the bigger wallets across the broader range still appear to be net distributors over the larger trend. And that distinction is everything. Because a short burst of dip buying is not the same thing as a major class of holders flipping into full accumulation mode. One is tactical, the other is structural. One can create a bounce, the other can create a trend. And if you confuse the two, you will keep buying relief rallies as if they are the start of something bigger, only to watch them roll over again. That is exactly how retail gets trapped in this phase of the market. Not because retail is stupid, because retail sees movement and assumes meaning. A sharp bounce feels important. A good day feels like confirmation. A recovery feels like the bottom. But markets do not care what feels good. They care who is still holding supply and whether that supply is being released or locked away. This is why Bitcoin around these levels is so deceptive. It can look resilient and weak at the same time. It can look like accumulation and distribution at the same time. It can look like a coiled spring and a bull trap at the same time. Because different wallet classes are doing different things. And until the larger holders stop feeding supply into strength, the market remains capped. Not permanently, but enough to punish impatience. Now let's talk about why this matters even more in the current cycle. We are not in some random year with no larger backdrop. This is a post-halving environment. Historically, that matters. Reduced new supply colliding with rising demand has often created the most explosive phase of the Bitcoin cycle. That is why people stay obsessed with the idea that another major move higher must be coming. They are not inventing that from thin air. They are reading history. But history is not a guarantee. History is a framework. And inside that framework, corrections happen. Deep ones. Nasty ones. Corrections that convince people the cycle is dead, right before the next expansion begins. We have seen that before. Sharp peaks, violent pullbacks, then another leg higher that wipes out anyone who got too bearish too early. So the real question is not whether this correction feels uncomfortable. Of course it does. The real question is whether this is the end of the cycle, or the transfer phase before another leg. And to answer that, you need to stop staring at candles and start watching behavior. Because if this cycle still has more upside left, the whales will tell you before the chart does. They always do. Not on television, not on social media, not through dramatic announcements. Through accumulation, through wallet behavior, through exchange flows, through a slow but unmistakable shift from distribution into reloading. That is the signal. That is the turn. That is the moment the market stops being heavy and starts becoming dangerous to the upside again. And here is the frustrating truth. Retail is actually doing important work right now, even though retail is not strong enough to force the breakout by itself. Retail is absorbing supply. That matters. Every coin a whale sells has to be bought by someone. If smaller wallets keep stepping in, the supply does not disappear, but it does change hands. It moves from larger sellers into smaller, often more stubborn holders. That process can take time. It can be boring. It can be painful. But it is not meaningless. It is the market laying concrete under the surface. That is why sideways phases can be so misunderstood. People think nothing is happening because price is not exploding. In reality, everything important may be happening underneath the surface. Supply may be moving. Ownership may be changing. The conditions for the next expansion may be quietly forming while social media calls the market dead. But again, do not confuse groundwork with ignition. Groundwork matters. Ignition changes everything. You need both. And the ignition does not come from retail excitement alone. It comes when large holders decide the correction is over, the valuations are acceptable, the risk-reward has improved, and the next move is worth positioning for. When that happens, the market stops floating and starts repricing. Think back to earlier explosive phases in Bitcoin. They were not sustained by people buying tiny amounts with conviction. They were accelerated by large flows, serious flows, the kind of flows that remove liquid supply from the market faster than sellers can replace it. That is when candles stop looking normal. That is when the move becomes obvious. But by then, the best entries are already behind you. Which brings us to the most important part of this whole discussion. What do you actually watch? What is the real signal that tells you the whales are back? Not hope, not vibes, not one green candle, not someone posting a chart with arrows on it. You watch for three things. First, you watch whether the large wallet balance trend actually turns. Not a one-day fluke, not a little wobble. A real shift. A sustained move where the cohort that had been trimming exposure starts adding again over time. Even a modest positive turn, if it holds, matters more than a dramatic tweet ever will. Because it tells you the group that had been leaning on price is no longer feeding supply into every rally. Second, you watch whether accumulation broadens and stays elevated. Not just panic buying during a crash, not just a reflex response after a flush. Sustained accumulation during normal conditions. That is crucial. Because panic buying can be emotional. Broad, steady accumulation is deliberate. It tells you that stronger hands are not just reacting to fear, they are positioning for what comes next. Third, you watch exchange outflows. This one matters because when large holders are preparing to hold rather than sell, coins leave liquid venues. They move off exchanges. They go into deeper storage. They become harder to dump quickly. That is one of the cleanest structural tells in the market. Coins on exchanges are potential pressure. Coins leaving exchanges are often intent changing shape. Now imagine all three of those signals lining up at the same time. Large wallet balances begin trending up. Accumulation remains elevated beyond a panic window. Exchange outflows stay strong over a period of weeks. That is not noise. That is confluence. That is the kind of setup that changes the entire feel of the market. Because then you no longer have retail fighting uphill alone. Then you have retail holding the floor while larger capital begins pushing in the same direction. That is when Bitcoin stops chopping people to pieces and starts rewarding patience. Right now, we are not fully there. That is the honest answer. There are hints, there are glimpses, there are moments that suggest the groundwork is being laid, but the full confirmation is not clean enough yet to call this a structurally healthy breakout phase. And that means discipline matters more now than excitement. This is where people get themselves in trouble. They see a bounce and they FOMO. They see one positive data point and they assume the reversal is confirmed. They see one clean day and they forget the larger wallets may still be using that strength as an exit. And then they wonder why the move dies again. It dies because the structure underneath it was incomplete. That is why patience is not passive in this market. Patience is strategy. Let the small wallets keep doing what they are doing. Let the transfer continue. Let the larger players reveal themselves. Because when the real turn comes, it will not need to be sold to you. The data will begin to line up. The market will feel different. Rallies will stop getting crushed instantly. Pullbacks will get bought more cleanly. And the supply overhead that has been suffocating the chart will start to thin out. That is when conviction makes sense. Until then, caution is not bearish. It is intelligent. And here is the bigger psychological trap. A lot of people hear this kind of analysis and think it means the market is doomed. No, that is not the point. The point is not that Bitcoin is broken. The point is that Bitcoin is in transition. A market can be constructive without being ready. A market can be bullish longer term while still being frustrating short term. A market can be building a base while still punishing anyone who assumes the breakout has already happened. That is exactly why this phase is so hard for most people. It is not dramatic enough for panic. It is not strong enough for celebration. It is just confusing enough to drain discipline. And that is usually the phase where the best positioning is built. Because while most people are chasing emotional clarity, smart participants are watching for structural confirmation. So here's the bottom line. Retail is buying. That is real. Whales, across the broader picture, are still unloading enough supply to keep the market heavy. That is also real. Some mid-sized wallets did step in on weakness. That matters. But until the biggest holders stop distributing and start accumulating in a sustained way, Bitcoin is likely to remain trapped in this frustrating pattern where optimism builds fast and dies just as fast. That does not mean the next move higher is canceled. It means the market is not ready to give it to everyone yet. And when that changes, it will probably happen before the average trader feels comfortable. That is how these markets work. The turn begins quietly. The signals improve under the surface. Then price catches up. Then the crowd notices. Then the move feels obvious. Then the crowd chases it late. Do not be in that last group. Watch the wallet trend. Watch sustained accumulation. Watch exchange outflows. Those are your real tells. Those are the signals that separate a temporary bounce from a genuine structural shift. And until they align, do not let every green candle convince you that the whales have changed their mind. They have not fully shown that yet. But when they do, the market will not stay quiet for long. So now the only question that matters is this. Are the small buyers building the base for the next expansion? Or are they still catching supply from larger players who are not finished yet? And second question, when the whales finally stop dumping and flip back to accumulation, How fast do you think Bitcoin reprices from there? Drop your answer in the comments. Are you tracking wallet balances, accumulation data, or exchange outflows first? And if you want more analysis like this, no hype, no noise, just the real structure under the market, subscribe now and stay close, because the next big Bitcoin move will not start on your chart. It will start in the wallets.